Financial leverage. Financial leverage is the use of debt to buy more assets. Leverage is employed to increase the return on equity. However, an excessive amount of financial leverage increases the risk of failure, since it becomes more difficult to repay debt. Financial leverage simply means the presence of debt in the capital structure of a firm. Similarly, in other words, we can also call it the existence of fixed charge-bearing capital, which may include preference shares along with debentures, term loans, etc. Financial leverage, which is also known as leverage or trading on equity, refers to the use of debt to acquire additional assets. The concept of financial leverage is not just relevant to businesses, but it is equally true for individuals. Debt is an integral part of the financial planning of anybody, whether it is an individual, firm, or a company. In a business, debt, short or long term, is acquired not only on the grounds of need for capital, but also taken to enlarge the profits accruing to the shareholders. Let me clarify it further. An introduction of debt in the capital structure will not have an impact on the sales, operating profits, etc., but it will increase the share of the equity shareholders, the ROE %, return on equity. Financial leverage is the use of borrowed money, debt, to finance the purchase of assets with the expectation that the income or capital gained from the new asset will exceed the cost of borrowing. In most cases, the provider of the debt will put a limit on how much risk it is ready to take and indicate a limit on the extent of the leverage it will allow. In the case of asset-backed lending, the financial provider uses the assets as collateral until the borrower repays the loan. In the case of a cash flow loan, the general creditworthiness of the company is used to back the loan. The financial leverage formula is measured as the ratio of total debt to total assets. As the proportion of debt to assets increases, so too does the amount of financial leverage. Financial leverage is favorable when the uses to which debt can be put generate returns greater than the interest expense associated with the debt. Many companies use financial leverage rather than acquiring more equity capital, which could reduce the earnings per share of existing shareholders. When purchasing assets, three options are available to the company for financing: using equity, debt, and leases. Apart from equity, the rest of the options incur fixed costs that are lower than the income that the company expects to earn from the asset. In this case, we assume that the company uses debt to finance asset acquisition. Although financial leverage may result in enhanced earnings for a company, it may also result in disproportionate losses. Losses may occur when the interest expense payments for the asset overwhelm the borrower, because the returns from the asset are not sufficient. This may occur when the asset declines in value or interest rates rise to unmanageable levels. Degree of financial leverage. The degree of financial leverage is a leverage ratio. It calculates the proportional change in net income that is caused by a change in the capital structure of a business. This concept is used to evaluate the amount of debt that it is obligated to repay. The calculation is earnings before interest and taxes, divided by earnings before taxes. This measurement can also be used to model the proportional change in net income caused by a change in the interest rate, even if the baseline amount of debt remains the same. The degree of financial leverage is useful for modeling what may happen to the net income of a business in the future, based on changes in its operating income, interest rates, and/or amount of debt burden. In particular, when debt is added to a business, this introduces interest expense, which is a fixed cost. Since interest cost is a fixed cost, it increases the break-even point at which a business begins to turn a profit. The result is usually a higher level of risk, where a company can earn a great deal more money above its break-even level from the funds provided by the additional debt, but the higher break-even level also means that the company will lose more money if sales dip below the higher break-even point. When a company has a high degree of financial leverage, the volatility of its stock price will likely increase to reflect the volatility of its earnings. When a company has a high level of stock price volatility, it must record a higher compensation expense associated with any stock options it has granted. This constitutes an additional cost of taking on more debt. The metric can also be used to compare the results of several businesses to see which ones have more financial risk built into their capital structures. This information might lead an investor to buy the shares of a company with a higher degree of financial risk during an expanding economy, since the business should earn outsized profits on higher sales volume. Conversely, The same information would lead an investor to buy the shares of a company with a lower degree of financial risk during a contracting economy, since its lower break-even point should mitigate its losses. Thus, this type of analysis can be used to compare and contrast the likely financial performance of companies within a single industry, and reapportion investments among them, depending on the economic environment.